Index funds, mutual funds, ETFs, and hedge funds, they all invest your money. But what's the actual difference? Most people hear these terms and their eyes glaze over. But if you want to build wealth like Lucas and avoid the fees that keep Michael broke, you need to know which is which. In the next 5 minutes, I'm giving you the dead simple breakdown. First up, index funds. Think of an index fund like buying the entire pizza instead of trying to guess which single pepperoni is the tastiest. If you invest in an S&P 500 index fund, your money is spread across 500 of the biggest companies. The goal isn't to beat the market, it's just to match it. Because it's automatic, you get low fees and zero stress. Historically, this simple, boring approach beats almost everyone else in the long run. Then we have mutual funds. Here, you're pooling your money with others, but a professional fund manager, let's call him the chef, chooses the investments for you. The idea is that the chef is so smart, he can outperform the market. Sounds great, right? But there's a catch. These chefs are expensive. You're paying higher fees for their expertise, even if they actually perform worse than the boring index fund. Michael loves these because they sound fancy, but those fees are eating his future profits. Now, let's talk about ETFs, or exchange-traded funds. These are the cool cousins of index funds. They are basically a basket of stocks, but they trade exactly like a regular stock. That means you can buy or sell them anytime the market is open. They usually have very low fees and give you instant diversification. If you want the simplicity of an index fund, but the flexibility to trade on your phone during your lunch break at the office, ETFs are your best friend. Finally, the hedge funds. These are the VIP clubs of the investing world. They are usually for the ultra-wealthy or big institutions. They use aggressive strategies, borrowing massive amounts of money or betting against companies. The goal is huge returns, but they come with insane fees and massive risk. For 99% of us, hedge funds are totally unnecessary. They're high-stakes gourmet pizza investing, and usually the only people getting rich there are the guys running the fund. So let's recap with our pizza theory. Index fund, you buy the whole pizza, cheap and reliable. Mutual fund, a chef picks slices for you, expensive. ETF, you buy specific slices whenever you want. Flexible. Hedge fund, high stakes, VIP pizza, very risky. For most of us, index funds and ETFs are the easiest place to start. They're simple, they're diversified, and they don't eat your profits and fees. The best investment isn't the fanciest one. It's the one you actually understand and stick with for 20 years. If this cleared things up for you, hit that like button and I'll see you in the next video.